Stock Play of the Day is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Hello and welcome to the Stock Play of the Day. Today's stock is the QQQ. That is an ETF that tracks the NASDAQ. Today we'll discuss, should we pass or should we play? Hello, my name is Brian Overby. I am the Senior Options Analyst at Ally Invest, and I will be your host for today's show. My colleagues are not joining me today, so we're going to get a little bit more advanced here on our options strategy. We'll talk a little bit about the markets, but we're going to actually look at the QQQ and do a fairly sophisticated two-part trade overall in that underlying ETF. So to start with, I'm showing my watch list for the VIX index. We've had a lot of fireworks recently in the VIX. It's been making some headlines because we finally broke below that 20% range and actually stayed below it for quite a few trading days. But if I look at it right now, we have fairly flat markets. I'm looking at the S&P 500 index. That's down about 14 points. The Dow Jones Industrial Average actually set a new high yesterday, and that's trading fairly flat at this point in time. We have the Dow down about 40, almost a 0.5% at this point in time. The QQQs are down $2.40. And also we see the VIX index trading at 20.65. So we did have a little bit of a spike up in the VIX, and I'm going to highlight that in my chart over here. Recently, we did actually break above that 20% level. A lot of people have been talking about it. If you look at this one-year chart, going all the way back to when the pandemic was first announced, we had the big downturn in the marketplace. Here is that 20% level. It's provided a lot of support on the downside as far as volatility is concerned. And one of the things about volatility is just if we get a little bit more normalcy in the marketplace, volatility usually means uncertainty. And if we can have some sustained certainty, in other words, people believing in these new highs in the marketplace, overall, that's a good sign for the market. So right now, one of the things that I find a more positive scenario is that if we look out to April, that's the April futures contract that I'm highlighting here on my VIX watch list, and that's trading around 21.75. Now, it took a long time for that April futures contract to actually break below 25. And now it seems like it's here to stay. It's at 21.75 at this point in time. The May contract is at 23.39. So they're down a little bit today, but overall, just the fact that they've broken below the 25 level means that going out in the future, the marketplace is a little bit more comfortable with where the markets are at and what's going on in this world overall. Now, on Friday, we're going to have an unemployment numbers. That's kind of a big number. A lot of people are anticipating a good number overall on Friday. But then again, signs of good markets can sometimes be bad news overall, in that that might cause the Fed to react and do things that might hurt the market overall. So sometimes good news can be bad news overall as far as the market is concerned. So we're going to be watching that. The markets will be closed on Friday. It is a market holiday overall, but we do expect to get those unemployment numbers, and they should be a very interesting number this Friday. So we'll see what that does with the marketplace overall. Okay, so now if I take a quick peek and I look at the S&P 500 index, we're hanging right around new highs in the S&P 500 index. We're above the 20-day, above the 50-day, above the 200-day moving average. But what I find more interesting is that we're setting some new highs in the Dow in general, in the S&P 500 index, but not with the techs helping out. And if I look at the chart of the QQQ, which is going to be our stock play of the day stock, I should say ETF, we see that if I draw this trend line it looks like the QQQ is really fighting to break out to the upside. It really wants to participate in this rally in the marketplace. And we kind of see that we're kind of creating a springboard on the market. If we see, if we just draw this line right here, we got 1, 2, 3, almost 4 times that it's came up and touched that and just not been able to break out to the upside. And we also have a little bit of a trend line down below the marketplace. So basically, to me, the QQQ is saying something's got to give. We're floating right around the 20-day moving average. I think the NASDAQ would like to take back the 50-day moving average, i.e. the QQQ overall, and break a little bit to the upside. So we saw a very interesting inflection point right here where the trend line was touching up against this is the 50-day moving average, and we just couldn't break out to the upside on that. Okay. So we're going to look at a trade that's going to be, we're looking for some upside movement on it. We think that the market is going to move, but we're going to also give a hedge. Now, this Friday on the stock play of the day overtime, the markets will be closed on Wednesday. So we're going to do it just before the close on Thursday. We'll be taping it live. The markets will be open, but we'll be taping it at 3:30 Eastern time this Thursday. And we're going to talk about the alternative trade here in this situation. So today's stock play of the day paper trade, and I emphasize paper trade because it's not meant to be a recommendation overall. We're going to look at doing a long call spread. And we're going to actually set this trade up where we are going to buy an in the money call option and sell an at the money call option. So here we see it inside the options playbook. And by doing this trade this way, we are actually going to be selling more time premium than we are buying. And we're intentionally doing that. Now, most of the time when people think about long call spreads, you're paying a net debit for that trade, i.e. sometimes they're called a debit call spread because of that. But in this instance, we're going to be paying a net debit. But as far as time premium is concerned, we're going to be selling more time premium than we're buying. This will make the break-even point actually below where the current market is at right now. Now, I like doing these type of trades in highly volatile environments. When you have more volatility and you have a more premium actually in the call options and put options in general, because you can get them done for a little bit. You can be a little bit more aggressive on the pricing. You can actually get a little bit better fills, and it also allows you to hedge the trade a little bit easier. I can't really hedge option trades if I have no time premium to work with. So if I have a higher implied volatility, a little bit more volatility in the option contracts, it makes it easier to adjust that position. Why? Because I have that time premium to work with, and I can try to do some things that will bring in a net credit and reduce my risk overall to the account. So let's see how this all works out. So if I run to the Ally Invest option chains here, and we look at the QQQ, we see it down almost 1% today, down $2.48. Here's the expiration dates that we have available. I'm going to go out 10 days. Now, a lot of times I'd like to do this and not have a weekend included on it, but the fact that Friday is not going to be a trading day and we're doing this on Tuesday kind of pushes me out to the April 9th expiration date. We can't choose the day that we do the stock play of the day overtime. So we're using live market. So I'm going to go out 10 days on that trade overall. That means we got the April 9th expiration. This is kind of looking for a move to the upside. We're hoping that we do get that breakout, that the market is going to go somewhere over the next 10 days. And if that breakout is actually to the downside, we're going to actually do a hedge. We're going to make an adjustment on that trade. Okay, so right now, QQQs, it's important. It's at 313.58. We want to know where that at the money option contract is. We're going to go 4 points wide on this trade. So we're going to sell the 313, the most at the money option contract. That's so we're selling a lot of time premium here. We're selling $5.73, or we'll call it $5.75 worth of time premium at the midpoint. And then we're going to go down 4 points and we're going to buy the 309 strike. And that effectively creates our long call spread. Now, that strike is trading a fairly expensive option contract. It's trading for $8.37. Now, I'm going to look over here on the put side. This is just a quick way to try to see the approximate amount of time value that you're buying. And we're buying, if you look at the put, that's all, obviously the put strike is going to be out of the money. So that's all time value. And it's just a quick way to get, to do the math, to get an estimate as to how much time premium you're actually buying when you're buying in the money call options. So in this instance, we see that it's trading for $3. We'll call it $3.85. We're buying or we're selling $5 and we'll call it 65 cents. Overall, the market's moving fairly quickly. But I am selling almost about $2 more time premium than I'm buying. That's going to make our break even be below where the current market is at, i.e. meaning that if the stock just stays where it's at or the QQQ just stays where it's at, then this would be a profitable trade over the next 10 days, even though we're going to pay a net debit for this trade. Okay, so if we scroll down and we look at this, this is going to be our official paper trade for the week. We're going 4 points wide. We're paying I'll put it in the right rail. And we'll try to work it at the midpoint. The QQQs are some of the most liquid options in the marketplace today. So getting a midpoint fill is very feasible, but it's never guaranteed. So our official paper trade for this week is we're going to buy 1-by-1 long spread. We're going to pay $2. I'm going to say 55 cents just to try to keep the math fairly simple. And that's where we're going to work that order. So we're going to be buying to open the April 9th 309 strike call, and at the same time selling to open one of the April 9th 313 strike calls, the most at the money option contract. We're going to pay $2.55 for this. Now, the maximum that this can trade for is going to be $4, which is the width of the spread, right? So $2.55 minus $4 is $1.45. Now, we have a little bit more downside risk than we have upside risk. But remember, we sold more time premium than we bought. That means that if this market stays right where it's at, then we will actually be profitable on this trade. So now I'm going to highlight this inside the P&L graph, okay? So we're going to get rid of the paper trade out of the right rail. We're going to scroll on down, and we're going to look at the profit and loss graph on this position. So now we see, here's the underlying stock. That's that gray bar, $313 approximately. The purple line is the profit and loss as of today. And you'll see that if the market goes on up, we don't get paid right away. It takes a while. These got some decent implied volatility in it. It's part of the reason why we're doing the trade. And on top of it, we have a $313 stock. So both of those things are adding premium to our option contracts. Now, our break even is going to be down below the marketplace. And we see that as to where we cross that x-axis on our position. So if the market just stays where it's at, we can make that $1.45 at expiration. If it drifts higher, even better. We can make it sooner rather than later. But as expiration approaches, I'm going to go all the way down to 1 day, which really leaves 2 days remaining. We now see that in the last couple of days to expiration, that colored line eventually morphs into the dotted line at expiration. So we need time decay to work for us. And we do have a market holiday on Friday. So by Monday, something's going to happen in this trade, right? Overall, we're either going to probably make the adjustment on Thursday, and I'll show you that adjustment here in just a second, or we might be closing out this trade by Monday, just because if we are correct on our forecast, if we are, and the market is higher, then we should get a bunch of time decay over this 3-day market holiday weekend. And that would be kind of our goal over trade. All right. So now how would I approach this trade if the market opens up over the next couple of days and starts to drift lower or breaks to the downside based off of the chart that we were looking at? Well, I'm going to actually roll this into a long call butterfly spread. Okay, so how am I going to manage that trade? So what would be my adjustment? Now, a lot of times on the stock play of the day, we don't go into an adjustment on the day that we talk about it, but I have more time today because I don't have my colleagues. So I'm going to do this a little bit more advanced. And this is a very feasible trade overall, and a way that I like to adjust a lot of my spreads. I like to go from a long call spread into a butterfly, or maybe a butterfly into a short spread. I like swapping out of these trades as a hedging mechanism in the option trading world. So a little bit more advanced today, but here's the way that I would approach this trade. Okay, so let's get back to the Ally Invest option chain. And we do have our long butterfly spread on, okay? And I do want to let you know, I will answer your questions in the chat box, okay? So we have plenty of time. So if you have any questions, please put them in the chat box and I'll try to address them here at the end of the show. I'm a one-man show today, so I just would like to get them in there right now so that I can take a peek at them and we can try to address your concerns or questions. All right, so 313 is the strike that we're selling. We went 4 points wide. If we want to leg into a butterfly is really just made up of, and I'm looking here in the Ally Invest Options playbook, a butterfly is made up of one long spread where you buy strike A, sell strike B, and one short spread where we sell strike B, an additional option short, and buy strike C. So we need to do the second half of this trade, and that's going to be our hedge in this scenario. It's basically a trade that's going to say, well, I don't want the cheese anymore, just let me out of the trap. That's kind of our goal here by doing this trade. If we're paying on this trade $2.55, I have to say to myself, okay, how much risk am I willing to take on this trade? A lot of people might come on out and say, well, $2.55, if I lose half of that, so if it's trading for $1.25, I might just get out of that trade, right? That might be my approach to this whole strategy. On the upside, I'm hoping to make $1.45. If I make that on the upside, that's great. If I lose $1.25 on the downside, well, then I'm just going to get out and I'm going to close the trade. Okay, here's my alternative to that. If you look at this trade and we're selling the 113 strike call, I'm going to put this in. We're going to go out and buy the 317 call. All right. And we're going to look at this. This would be a butterfly. In this instance, that butterfly is trading for about 50 cents. That would be our maximum risk if we did the actual butterfly. We would have 50 cents as our net debit. Our net debit would be the total risk of the trade, and our maximum upside would be $4. So $4 minus that 50 cents would be $3.50. And if we hit a complete home run on the butterfly, that would be the maximum that we could make, which is very hard to do because the market would have to stop right at 313, very close to the expiration date for that to be feasible. Okay, so if this goes down, I'm going to remove the 309 strike call. And I'm going to add, and I'm going to make this just one contract of the 313 strike call. So this is my hedge. Right now, I see it trading for a $2 credit to the account. If I see this trading for $1, that means the market has gone against me, and I'm going to bring in a net credit of $1 to the account. By doing that, I'm going to lower the overall cost of my trade from $2.55 to $1.55. Now, I can choose whenever I want to roll into the spread, but bottom line is, if I roll into a butterfly, instead of just closing out the trade, I still got my toes in the water, right? I still have a chance for the marketplace to come back. So in general, if we're down maybe 2 or 3% on over the next couple of days in the QQQ, I'm going to keep a close eye on the cost of this spread. This is what's going to affect me more than anything. I'm going to keep a close eye on it. And if this thing starts trading for around $1, then I'm going to sell the spread, effectively create my butterfly, and then play the hope game and hope that the underlying market actually comes back and lands within my strikes. Okay, so if I go back, I have this position on, and I'll work through it in the profit and loss graph here. We have a 1 by 2 by 1 butterfly is what we're going to put on. So this is the official butterfly. So if we rolled into that position, this is what our ultimate final position would look like. Now, Hopefully we're correct on the forecast and the market just goes up. But as I always want to emphasize, we're just learning here on the stock play of the day. But if I'm looking at that trade and the market goes up, well, then this trade is very simple. You just let it roll. You let time decay work for you, close it out next week. In this instance, though, if the market does go down, what I'm going to end up doing is rolling into this butterfly. And then at expiration, if the market comes back and it lands somewhere in between the 317 strike and the 309 strike, then I could potentially be profitable on this trade or somewhere in between. Maybe I just want to get my dollar back from putting the trade on, selling this for a minimal gain, but I don't want the cheese anymore. I just want out of the trap. And I'm going to end up with a 8-point range approximately where this thing could land and actually help me out on my position. I'm going to have to watch it closely as expiration approaches, but this is going to be the hedge to that position. So I always like to go through it this way by looking at the profit and loss calculator and trying to show you exactly how your profit and loss graph changes. Okay, so to start with, we do not have the 317 and we have one of the 313s, right? If I look up and I graph it right now, I'm just going to hit graph, we see our long call spread. Now, if I scroll down and I say, okay, we are incorrect on our forecast. We see the market going down 2, 3, 4%. On the way down, we look at our short call spread, which means we're going to be selling one more 313. So I'm going to add one here. And then we're going to buy one of the 317s. And so I add that. And we look at our trade now, and we see now we have our butterfly trade. So I start with a long call spread. If I'm correct on my forecast, no worries. I close it out. I get out of my position. Maximum I could make on that would be $1.45. Overall, it's a simple trade if the market just stays where it's at or starts to go higher. On the downside, if it breaks to the downside, I roll into the butterfly and then I play the hope game. And this will be my ending position as far as the P&L graph is concerned. I don't know exactly what my risk is because I haven't rolled in to the butterfly yet, but it would be my net debit paid for this trade overall, which was my maximum risk to start with, minus whatever credit is received when I roll into the butterfly. All right, so I'll leave the profit and loss graph up, and now I'd like to run over the chat box and see if you have any questions overall. So if you have them right now, you can put them on in the chat box. All right, I have one quick question that just came up. Overall, the very first question that I have is, why are we going out to the April 9th expiration? And I think that question overall, I kind of addressed at the very beginning of the show. This Friday is a market holiday. So because of that, and we're taping this on Tuesday, that only gives you all day Wednesday, all day Thursday to actually, before you'd be looking to get out of the trade. Normally you'd have all day Friday too. So because of that, we're going to adjust our expiration. I don't mind doing this type of strategy in the short term and actually having a Friday expiration date. But since it's a market holiday this week, we're going to go all the way out to next week, which is the April 9th expiration. All right. Is there so now this is from John M. Is there a strategy for rolling into this at a later date? Well, we're going to come back on this Thursday. We're going to be looking to tape the stock play of the day overtime on Thursday. And honestly, since this is a learning, basically video series that we do, if the market's down, we'll have something to show you. Hopefully we'll have be able to roll into that butterfly because the market has gone against us, and we'll see a live example of how that's happened. Usually you don't hope for your forecast to be incorrect, but if we're learning here on the stock play of the day, which is always our goal, on Thursday before the close is when I would look to adjust this trade. So my adjustment would be to actually to actually leg into the butterfly. Now, I'd much rather leg into strategies than roll and just trying to put the loss out further in time and and hope that the market does what I was planning on in the first place. And I always don't want to over adjust. So once, especially on a 10-day trade, I'm going to make one adjustment. And if that adjustment helps out, then I'll just let this underlying ride, and then I'll be out of the position at that expiration date. Or if I can close it out and be profitable to start, be profitable from my adjustment, well, then I might close out that trade and move on with it. But I don't like to adjust too many times. Transaction fees, you're always paying commissions. You always got to think about that. And also bid-ask spreads. When you're doing 2, 3, 4 adjustments, those hurdles are really hurting you overall. All right. Can you adapt that butterfly to a few weeks past the April 9th expiration? Yeah, you could. You could do it a couple of weeks past. One of the biggest things, though, about the butterfly and why I might not go out further in time is the profit and loss graph. If I put this profit and loss graph on and I adjust that butterfly, and let's say we have 18 days remaining to the expiration date, you'll see, well, let's go out 18 days. Let's go all the way out as far as we can on this. Yeah, see how much flatter? That was actually very dramatic. The profit and loss graph becomes a lot flatter over time. So when you're doing butterflies, they max out closer to the expiration date. Also, when you're doing long spreads, because when you do a long call spread, you're selling an option contract that wants the market to go down, and you're buying an option contract that wants the market to go up. So they fight each other. So in order to get the maximum at expiration on a long call spread or on a butterfly, if you're correct on your forecast, you're short 2 at-the-money option contracts. That's where all the time premium is at. So on my butterfly and on my long spread, they're going to max out closer to the expiration date. So picking your expiration, we want to choose that wisely. And a lot of times if I'm doing this strategy, like say we were in the SPX as opposed to the QQQ, the SPX is a higher valued index overall. And because of that, I would want to go shorter term because just the overall cost of the SPX would add premium to my option contracts in general. All right. One last thing. I'm very new to options, but I'm very new to options, but not to stocks. This is a good play for a knob. Well, I don't know if I'd use those words overall. This is for a novice, if we can adjust what's in the chat box. For a novice overall, this strategy, doing a long call spread is, I guess, is the next level above just buying calls outright. This trade today is a little bit more advanced. And part of the reason why I'm doing that is I don't have my colleague, either Lindsay Bell or Callie, to help me out with the analysis today. So I have a little bit more time to address my alternative if I was incorrect on my forecast on my long call spread. So overall, this is a little bit more advanced strategy. We have a lot of basic like FOMO trades, fear of missing out, buying into money long calls. You can watch all the videos. They're all here on the Ally Invest YouTube channel. And I think that's going to be it for this edition of the Stock Play of the Day. Remember, I'm going to be back on Thursday at 3:30 Eastern time to do the overtime show because the markets will be closed on Friday. So you want to click subscribe. You want to ring the bell to get that reminder. And we'll see you this Thursday for the Stock Play of the Day overtime edition. Thanks for coming, everyone.